Howdy, everybody. Welcome to Liberty Call. Today is Thursday, December 12th, 2024. Hope you're having a fantastical day out there in the interwebs. It's a little gloomy right now. It was sunny this morning, but looks like some clouds are coming in, so makes it colder. Anyways, hope you're having a fantastic time, and my TV just went off. So, all right. Well, before we jump into today's news, markets were kind of in a mood today. And but before we get into that, if you could do me a favor, give me some thumbs up, like, share, subscribe, follow, and press that notification bell. All righty. Well, now it's time to hop into the markets. Dow Jones was down 0.53%, 234 points, closed at 43,914. The S&P 500 also down 0.53%, closed 32 points, closed at 6052. NASDAQ down 0.65%, 129 points, closed at 19,905. The VIX was up 2.28% today. It's at 1389. Canada was down 0.96. Brazil was down 1.31%, and Mexico down, looks like their markets were closed today, so we'll skip that. All righty. Over in Europe, Germany was up 0.15%, the UK up 0.12%, France flat down 0.03%, the Netherlands down 0.19%, Spain down 0.21%, Italy up 0.36%, Switzerland up 0.25%, and Portugal up 0.14%. Russian exchanges in the red again today. The MOEX down 0.88%, RTSI down 1.53%. And the Asian markets, the Nikkei in Japan was up 1.27%, big jump there. Australia down 0.28%. New Zealand, when it closed on the 11th, was up 0.35%. Let's see here in China, the Shanghai was up 0.85%. Shenzhen Component up 1% flat. China A50 up 1.32%. DJ Shanghai up 0.82%. Hang Seng up 1.2%. And the Taiwan weighted up 0.63%. All right, so those are the markets for today. So not quite sure why probably had to do with the producer price index. That would be my guess, is why the markets reacted negatively, even though everyone seems to think that the Fed is going to continue their rate cuts next week on what's the 17th and 18th. That's probably Tuesday and Wednesday of next week. So. All right, well, let's get to the market recap. U.S. stocks slightly lower after upside inflation surprise. We just covered the CPI yesterday. I mean, it was still a little warm. I mean, anyone who considered that was as a victory got another thing coming. All right, U.S. stocks edged slightly lower on Thursday, following a hotter than expected inflation report that sent Treasury yields climbing. This decline came after the NASDAQ closed above 20,000 for the first time on Wednesday, buoyed by a strong rally in technology stocks driven by the prospect of near-term rate cuts. Woohoo! The producer price index surprises. While the consumer price index met expectations earlier in the week, the producer price index rose more than anticipated in November. The PPI increased 0.4% for the month compared to an expected 0.2% and climbed 3% year over year, up from October's 2.6%. Despite the upside surprise, market expectations for a Federal Reserve rate cut next week remain intact. However, the data highlights persistent inflationary pressures supporting a cautious monetary policy stance for 2025. Mixed corporate performance. Adobe Systems tumbled over 12% after issuing weaker than expected annual sales forecasts and citing delays in realizing returns from its AI-driven initiatives amid rising competition from smaller players. ServiceTitan surged over 40% in its NASDAQ debut after pricing its $625 million IPO at $71. The cloud software provider's strong debut contrasts with Adobe's struggles. Warner Brothers Discovery jumped more than 14% to a 52-week high after announcing plans to separate its cable TV business from its streaming and studio units. Conversely, Chewy fell nearly 1% as its top stakeholder announced a $50 million stock sale. Well, sorry, I didn't buy my dog food from Chewy in the last month, so if it's me, I apologize. I picked up the pups' food at Sam's this last time. All right, finishing up, the stronger than expected PPI report reinforces the need for patience in the Federal Reserve's monetary policy, signaling potential headwinds for equities in 2025 despite expectations for rate cuts next week. Earnings results continue to drive into individual stock performance amid broader macroeconomic concerns. I think they should have kept rates high, but, what do I know? had to make sure big business in Wall Street and everyone else had an easy end of the year. So, hope it helps them. All right, let's jump into some data. November PPI. This comes to us via First Trust and Mr. Andrew Opdyke. All right, the Federal Reserve is expected to cut rates at its upcoming meeting, but concerns about inflation remain prominent. Producer prices rose 0.4% in November, with food prices surging 3.1%, driven by a 54.6% increase in egg prices due to bird flu. Energy prices increased slightly by 0.2%. Even excluding volatile food and energy prices, core producer prices climbed 0.2% for the month and 3.4% year over year, accelerating significantly from 1.9% in November of last year. Service prices, particularly trade services, drove the increase, offsetting declines in transportation and warehousing costs. Core goods prices, excluding food and energy, rose 0.2% in November and 2.2% from a year earlier. Supply chain indicators showed stability with no change in processed goods prices and a 0.6% rise in unprocessed good prices in November. However, both categories are down year over year. Inflation's trajectory hinges on the services sector's activity and money supply changes. The M2 measure of money, while rising gradually since November of 23, remains below its April 2022 peak. A potential reduction in federal spending in 2025 could slow economic growth temporarily. If the Fed responds with aggressive rate cuts, it risks reigniting inflationary pressures. That's kind of what we're dealing with now. In labor news, initial jobless claims rose 17,000 to 242,000, while continuing claims increased by 15,000 to 1.886 million. Excuse me. These figures suggest ongoing job growth at a slower pace compared to a year earlier in the year. The Fed faces a challenging balancing act, curbing inflation while fostering economic growth without overcorrecting through rate cuts. And again, why are they cutting rates? Inflation is still warm. I mean, you really shouldn't even be cutting rates until you get below 2. And then at that point, you start lowering rates. And then when it, you get, where it stabilizes, at around that 2% mark is what I would have done. But again, I didn't go to fancy colleges and stuff like that. I just read books and listened to some smart people. All right. Alrighty, let's jump into this next one. Government spending shock. U.S. budget deficit soars in worst start to year on record. Well, that's some good news. Alrighty, the U.S. budget deficit reached unprecedented levels in the first 2 months of fiscal 2025, driven by surging government spending and stagnant tax revenues. November alone saw a record $584.2 billion in federal spending, a 14% year-over-year increase, largely attributed to higher expenditures on Medicare, Social Security, defense, and healthcare. Are we at war? Is someone attacking the United States? Was I unaware of this? Our defense bills should be going down. This follows October's record spending, pushing the 2-month combined deficit to a staggering $624.2 billion, 64% higher than the same period in fiscal 2024, and the worst start to a fiscal year in U.S. history. All right, way to go, America. All right, tax revenues, while up 9.8% year over year to $301.8 billion in November, have failed to keep pace with spending. Calendar effects, such as deferred tax payments, played a role in distorting monthly comparisons, but even adjusted figures reveal alarming trends. A key concern is rising debt servicing costs. Gross interest payments in November totaled $87 billion, up $7 billion from the prior year, with total U.S. debt now at $36.2 trillion and interest rates elevated. December's interest outlay is projected to exceed $150 billion. The trajectory of U.S. debt, now 120% of GDP, underscores the monumental fiscal challenges ahead. President-elect Donald Trump faces significant hurdles in addressing this crisis, even with efforts like Elon Musk's Department of Government Efficiency, DOGE. However, politically sensitive areas such as Medicare and Social Security dominate federal outlays, making meaningful cuts difficult without severe political and economic repercussions. Without drastic reforms or effective spending reductions, rising debt and interest obligations threaten to destabilize fiscal stability, raising the specter of a long-term financial crisis. Well, I mean, if we don't do something, those freebies that we and bennies that we hand out to the old farts, healthcare and Social Security, those are going to be gone. I mean, if the government collapses, then there's nothing. I mean, this is why, I've been bitching and moaning about this for, 15 years, that why not fix the problem? Sit down, create a budget, slash the spending, lay off all the federal employees that you can. Those people can go be productive in the private sector where they should be working. And, we pay this off. Maybe, we can't continue to inflate the dollar, because that's been their plan all this time is, well, we'll just keep the debt where it is and we'll inflate the dollar, a bunch so that, we can pay it off with, deflated dollars and, then we get more bang for our buck. But it doesn't work like that. It never does, because they continue to pile up debt on top of it. Anyways, all right, one last article, not any more good news, also from Zero Hedge. Janet Yellen is sorry after presiding over $15 trillion in increase in U.S. debt. I think she only has a job because she's a woman. I mean, I've heard her speak on dozens of occasions, and she is not a very bright person. So I don't know how she got in this position in the first place. All right. Outgoing Treasury Secretary Janet Yellen recently expressed regret over the lack of progress in addressing the U.S. fiscal deficit during her tenure. However, her remarks have drawn sharp criticism given her pivotal role in unprecedented expansion of U.S. debt during her time as Federal Reserve Chair and Treasury Secretary. Yeah, she's had two of the most powerful financial positions in the country over the last, 20 years? During a conversation with Scott Bessent, President-elect Trump's nominee for Treasury Secretary, Yellen underscored the importance of the Federal Reserve's independence and warned against sweeping tariff hikes. Okay, this is the same woman who kept interest rates at zero during Black Jesus' presidency simply because of political pressure. So she didn't want to raise rates, to normalize things during his term. And, it wasn't until she was out the door and what's his name, Powell came in that they actually started raising rates. But then in 2019, the wheels started to come off, and then we had COVID. And anyways. Let's see here. Yet her tenure is marked by a massive $15.2 trillion increase in U.S. debt, representing 42% of all debt ever issued. This includes a $6.8 trillion accrued during her leadership at the Fed, and an additional $8.4 trillion under her watch at the Treasury. Critics argue that Yellen's policies, including maintaining zero interest rates and facilitating debt-funded government spending, exacerbated the nation's the Republic's fiscal challenges. Her leadership during Biden's administration saw record government expenditures, with spending outpacing stagnant tax revenues. In the first 2 months of fiscal 2025 alone, which we just covered in the previous article, the U.S. budget deficit ballooned to an unprecedented $624 billion. The surging debt has driven U.S. interest expenses to $1.2 trillion annually, making it the second largest government outlay after Social Security. This debt trajectory threatens fiscal stability and could spark a severe financial crisis. While Yellen's acknowledgement of fiscal concerns may seem contrite, critics view her regrets as insufficient, emphasizing her significant role in fostering the current unsustainable debt environment. As the U.S. navigates the precarious fiscal future, her tenure serves as a cautionary tale of long-term consequences of unchecked government spending. Yeah, I'd round up all those idiots who've created this mess and send them to the salt mines and make them spend the rest of their lives breaking rocks or whatever. Just leave them in prison until they give them a little farm. They can feed themselves, but don't really help them out. I mean, because again, they've destroyed our currency. They've in a lot of ways just destroyed the government and have created a lot of problems. I mean, then you pile in all the cultural issues that the left and right fight about, and why are we keeping this? I mean, let's blow it up and just go back to the States. And if you want to live in blue land, move to California. If you want to be in ultra red territory, move to Oklahoma. I mean, vote with your feet, people. All righty. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a buzz. I'd be glad to help. All right. Well, like I said, that's everything I had to cover. Hope everyone has a wonderful evening, and I'll talk to everyone next time. Adios.